Hi there. Moving your sole trade into a limited company can create CGT issues, but Incorporation Relief may postpone qualifying gains.
Right, let's get straight into it. If you are a highly profitable UK sole trader, or perhaps a landlord managing a seriously growing property portfolio, deciding to incorporate your business into a limited company is a massive milestone. But honestly, it can also be an absolute minefield. Today, we're diving deep into Incorporation Relief, specifically moving a sole trade into a company without triggering capital gains tax in the UK. I'm your host, and as the experts at ProTax Accountant, a leading UK accounting firm advising businesses just like yours on tax planning and compliance, we are going to walk you through exactly how to protect your wealth during this transition. We're here to bring you peace of mind so you don't accidentally step into any hidden tax traps.
Okay, picture this scenario for a second. You've spent years pouring your blood, sweat, and tears into building a thriving UK business or a robust property portfolio. You sit down with your advisors and decide, you know what? It is finally time for the legal protection, the limited liability, and the tax efficiency of a limited company. So you sign the paperwork. You assume it's just a simple administrative shift. And then, out of absolutely nowhere, HM Revenue and Customs hands you a staggering $340,000 capital gains tax bill. It sounds insane, but it is a terrifying real-world scenario. A lot of successful founders just want to protect their personal assets from business liability, and they are completely unaware that simply changing their legal structure triggers a massive tax event.
So what does this all mean? Well, it brings us to a catastrophic problem known in the tax world as a dry tax charge. Here's the deal. When you incorporate, HMRC literally views this as you selling your business to your own newly formed company. Because you and the company are separate legal entities, capital gains tax is assessed on the open market value of the assets you transfer. The absolute nightmare here is that you now owe hundreds of thousands of pounds to HMRC right now. But because you essentially just sold the business to yourself in exchange for company shares, you haven't actually received a single penny of liquid cash to pay that massive tax bill.
But don't panic. At ProTax Accountant, we have a structured roadmap to solve this exact problem. Today, we'll be covering the upfront tax nightmare, how Incorporation Relief works, beware the mixed consideration, landlords and the Ramsey test, the 2026 compliance trap, and finally, how to protect your business today.
Let's kick things off with Section 1, the upfront tax nightmare.
Now, while startups, SMEs, and independent contractors are all touched by incorporation rules in various ways, our focus today is laser-targeted on established UK business owners and property landlords with assets exceeding £250,000. That's where the tax stakes get incredibly high. When you move an unincorporated business into a corporate entity, the default tax treatment in the UK is that this transfer is a disposal at open market value. Why? Because, as we just mentioned, in the eyes of the law, you and your new limited company are two entirely different legal persons. This immediately triggers capital gains tax on all your appreciated business assets. We're talking about freehold land, commercial buildings, and this is a big one, self-generated goodwill. Without the right planning, incorporating is basically a financial disaster waiting to happen.
Which brings us nicely to Section 2, how Incorporation Relief works.
Thankfully, there is a statutory lifeline designed specifically to save you from this upfront tax nightmare. It's found in Section 162 of the Taxation of Chargeable Gains Act 1992. Section 162 Incorporation Relief is what we call a statutory rollover mechanism. Now, I want to be crystal clear here. This is not tax evasion, it's tax deferral. Rather than paying the CGT today when you incorporate, the capital gain you make on the transfer of your business is essentially rolled into the base cost of the shares you receive in your new company. So if your business has a $500,000 gain, the starting value of your shares for tax purposes is simply reduced by that $500,000. The tax charge is effectively postponed entirely until the day you eventually sell those corporate shares for cash down the line. However, you must satisfy some extremely strict statutory conditions simultaneously. If you miss even one of these, the entire relief collapses. First, the business must be transferred as an active going concern. Second, you must transfer all assets, except cash, to the new company. And third, the exchange must be wholly or partly for shares. I really need to give you a severe warning here regarding that all assets rule. Let's say you're a landlord transferring a multi-million-pound property portfolio, but you decide, you know what, I'll hold back just this one family favorite rental property in my personal name. Or maybe a sole trader keeps their book debts personally just to collect them tax-free. By holding back that single asset, you completely breach the condition. You will be disqualified from the relief across the entire transfer, triggering the full tax bill immediately, no exceptions. Let's move on to Section 3. Beware the mixed consideration. Now, what's really interesting about this next part is how tricky incorporation relief gets when you decide you want to be paid by your new company in something other than just shares. Take a look at the breakdown here. If your company pays you by issuing shares, that's the large portion you see, plus crediting a director's loan account or giving you cash, the smaller portion. This is what we call mixed consideration. When you do this, Section 162 only applies partially. The portion of the gain that corresponds to the shares, that's safely deferred. But the portion corresponding to the director's loan account or the cash, that becomes immediately taxable right now, which creates that unexpected dry tax charge we talked about earlier. Let's actually walk through the maths using HMRC's own formula just to show you how punishing this can be. The rolled over or deferred portion is calculated as the total gain multiplied by A over B. A is the net value of the business, and B is the total consideration you receive. So let's say an owner has a £34,000 total gain. Because they took £26,000 as a director's loan, rather than just taking shares, the formula severely restricts their relief. As you can see, they managed to defer £19,267, but they are hit with a £14,733 dry tax bill, right on the spot. It is definitely worth noting, though, that a rule called Extra Statutory Concession D32 does allow HMRC to safely ignore genuine business liabilities, like a commercial mortgage, for instance, that are taken over by the company. Those won't count as taxable non-share consideration. Did you know? Many companies encounter this issue when reviewing their tax position, entirely unaware that goodwill is a chargeable asset. This is absolutely crucial to understand. Goodwill, which is the intangible value, those loyal client lists and the brand reputation you've built over years of hard work, is a highly valuable, taxable asset. When you incorporate, you are effectively selling that goodwill to your company. HMRC wants their cut of that value, and the hidden capital gain on goodwill catches so many founders completely off guard when the tax bill arrives. Let's pivot slightly to Section 4. Landlords and the Ramsey test. For any UK property landlords watching who are looking to incorporate a portfolio, the rules here are deeply contested. HMRC heavily scrutinizes property portfolios to figure out if they are genuinely a business for tax purposes or just a passive investment. To get Section 162 relief, you absolutely must be transferring a business. But where is the boundary? Well, on one side, we have an active business. The landlord spends 20+ hours a week personally doing things like property maintenance, tenant support, and active management. On the other side, a passive investment. The landlord has delegated pretty much everything to a managing agent and does very little beyond looking over monthly financial statements. HMRC's stance is incredibly firm on this. Passive investors simply do not qualify for incorporation relief. And this brilliantly illustrates the legal benchmark for this rule, which was established in the landmark 2013 Upper Tribunal case of Elizabeth Moyne Ramsey versus HMRC. Mrs. Ramsey and her husband personally spent around 20 hours a week managing a building split into 10 flats. When she incorporated, HMRC aggressively challenged her. They claimed she was just a passive investor and slapped her with a massive tax bill. She actually had to fight HMRC all the way to the upper tribunal, where the judge finally ruled that her activities went beyond passive investment. She proved her portfolio was a legitimate business, and she rightfully won her tax relief. But it really shows just how aggressively HMRC will pursue landlords on this specific issue. Professional tip: maintaining proper contemporaneous records of the hours you spend managing your business is essential for HMRC compliance. I literally cannot stress the word contemporaneous enough for landlords. You have to document your 20+ hours of activity meticulously, week by week, well before you even contemplate incorporation. If HMRC audits you and you try to retroactively guess your hours 3 years after the fact, they are going to simply reject your claim. Real-time logging of your maintenance, your tenant calls, and your admin work is your absolute best defense here. So the crucial point we need to discuss now is Section 5, the 2026 compliance trap. There is a terrifying regulatory urgency approaching that is going to fundamentally change how this relief operates for the 2026/2027 tax year. Historically, up until April 5, 2026, incorporation relief applied automatically. Provided you met all those conditions we talked about, you simply didn't report a gain, and the relief just worked quietly in the background. But the Finance Act 2026 changes everything. For any business transferred on or after April 6, 2026, the relief is no longer automatic. This is a massive trap for business owners who might be relying on outdated advice, because failing to actively claim the relief on your tax return will result in a catastrophic, entirely unplanned capital gains tax bill. Moving forward, HMRC now demands that you make a formal, active claim on your self-assessment return for the exact year of the transfer. You have to proactively provide brief details of the transaction, the specific tax computations, and clearly state the type of business transferred. Plus, while a formal valuation of your newly issued company shares isn't strictly required for the Section 162 calculation itself, the underlying properties and chargeable assets being transferred absolutely must be accurately valued so that the deferred gain is calculated correctly. Let's wrap things up with Section 6, Protect Your Business Today. As you can see, the stakes of incorporation are incredibly high. It is quite literally a one-shot deal. But with the right structure and expert help, this transition can be managed flawlessly to protect your wealth. Let's quickly summarize your critical takeaways. Number 1, you must transfer all assets, except cash, to avoid disqualifying your relief entirely. Number 2, be acutely aware of the mixed consideration trap. Taking a director's loan or cash triggers immediate tax. Number 3, if you are a landlord, meticulously document your active hours to pass that Ramsey test. And finally, number 4, you absolutely must not forget the mandatory active claim required from April 2026. A single misstep on literally any of these points can cost you hundreds of thousands of pounds. Please note this strict disclaimer before we finish. This explainer is for educational purposes only and does not constitute professional, financial, or tax advice. Incorporation is a highly complex one-shot deal, and you must take independent professional advice before acting on anything we've discussed today. And that is exactly where we come in. We enthusiastically invite you to contact Pro Tax Accountant for bespoke UK tax planning that's tailored to your exact situation. You can call us on 079 8568 9912. Email us at info@protaxaccountant.co.uk or visit our website at www.protaxaccountant.co.uk. And hey, if you found this breakdown valuable and you want to stay ahead of HMRC, please subscribe to our YouTube channel for more expert explainers. I'll leave you with this final provocative thought. Are you actually prepared for the mandatory 2026 tax changes, or is your incorporation a ticking tax time bomb? Don't leave your hard-earned wealth to chance. Reach out to Pro Tax Accountant today for immediate professional guidance. Thank you so much for listening.